Hello, let's work on an exercise in which we're going to go through several steps of the accounting cycle. And this exercise on January 1st, 2024, we have the general ledger of big blast fireworks, which includes the following accounts. So this is essentially the post-closing trial balance from the previous year, December 31st, 2023. These are the opening numbers for January 1st, 2024. I will put all of that information into the T accounts a little later. For now, let's continue reading the information presented. We have the inventory of 30,000. This comprises of 300 units for which we had paid $100 a piece. And then we have these journal entries, these transactions that have happened for which we need to do journal entries. So what I'm going to do over here as we go along is I'm going to have some notes in place. And one of them is my inventory record. So this first piece of information presented, I'm going to put that in over here. I'm going to write down the date, the number of units, the cost per unit, and then the amount, which is nothing but units multiplied by cost per unit. So to start with, I have started the year with 300 units. This is the balance from the previous, at the end of the year, what I had, okay? So on the 3rd, I purchased 1,200 units for $126,000 on account. They're telling me it cost $105 each. You can do 1,200 times 105, you'll come up with this 126. We're using the perpetual inventory system, so my journal entry is fairly straightforward over here. It's going to be inventory debit, accounts payable credit, $126,000. On the 8th, I made another purchase. This time I have 1,300 units that I've paid 110 each for 143,000. So 1,300 times 110 will give me 143. So I go ahead and do that journal entry. It's similar to the previous one, inventory debit, accounts payable credit. On the 12th, I have yet another purchase, 1,400 units at 115 each. 1,400 times 115 will give me 161,000. Again, this journal entry looks very similar to the previous one, except for the dollar amounts, obviously. Let me go ahead and put this information over here as well. So I have, didn't mean to cross it out as yet over here. So let me take out the strike through. Okay. So I have on the 1st, I had 300 units. Then I made 3 purchases. So now I have all of these units are available for sale. And when I add up all of these amounts, this is the cost of goods available for sale. I'm not sold it as yet. On the 15th, I returned 100 units. The 100 units that I returned are the ones I purchased on the 12th. The reason that's important is this cost per unit, 115. So this is return. I'm returning. Again, I do not need that strikeout, so let me take that off. Okay, I am returning $11,500 worth of inventory. To the extent I return the inventory, my inventory balance goes down and my accounts payable balance goes down. So essentially this journal entry, I need to reverse it. So on the 15th, accounts payable debit, inventory credit, 11,500. That's the 100 units that I returned. Now, I had 1,400 that I purchased, 100 are returned. So after the return, how much am I left with? This is what I'm left with, okay? So these numbers over here, essentially I'm going to put a strike through over here indicating don't take this into account anymore. What I have is 4 layers, 300 units, 1,200 units, 1,300 units, and 1,300 units. The 1,400 dropped to 1,300 units, and I know what the cost per unit is. Now, all of this is important for the next journal entry. The next transaction tells me that I sold 4,000 units on account for $600,000. So let me first do that journal entry to record the sale. It's on account, so accounts receivable debit, sales credit, $600,000. So that part is fairly straightforward. Then continue reading. The cost of the units sold is determined using FIFO perpetual inventory. Now this is important. I need to calculate the cost of goods sold. I need to do a journal entry on the same day. Cost of goods sold debit, inventory credit. The inventory that I'm selling, the 4,000 units that I'm selling, I need to expense them. And the way I'm going to do that is I'm using the first in, first out. So I look at these layers. Layer 1, 2, 3, and 4. Remember, it's chronological by date, first in, first out. Whatever came in first, that's a beginning inventory that needs to go out first. That's a 300 units. Then the 1,200, and then the 1,300, okay? Now I need a total of 4,000. So if you add up these numbers, we have 2,800, which means I need another 1,200. Okay, from the 1,300, I'm taking 1,200. That's what I'm selling. Now I know the unit cost for each of those layers. My cost of goods sold is $437,000. Okay, so let me take a look over here for a quick second. I'm going to need to just drag this one thing out over here. Okay, this is what I needed to bring up over here. So bring that back into position. My cost of goods sold is 437. That's where this number is coming from, the 437. Okay. Inventory credit for that same 437. We're using the first in, first out, which is why it was important to stack up these layers so we know which ones we're selling first. Okay. Now, I don't need this information right now, but I'm going to go ahead and do it anyways to make it easier for the next step. This 300 is all sold. 1,200 is all sold. This 1,300, the January 8th purchase, that's all sold. Of this 1,300, 1,200 is sold. So what is left with me? After this return was made, remember I bought it on the 12th and I made a return. I had 1,300 left, I said, on that day. Okay, let me write that date again. Of that, what's left is 100 units. Again, 1,300 minus 1,200. And that 1,300, remember, I had purchased at 115. So in my books, my inventory is at 11,500. If you do a T account, make a T account, beginning balance, do all the debits and credits for inventory, you should work out to 11,500 at this point of time. Okay. We will need this subsequently, this information. So at this point, I just have updated my records, my notes, personal notes, and I have this information. Let's continue with the transactions. On the 22nd, I received 580,000 from customers on account. The customers who owed me money, they're paying me. So it's cash debit, accounts receivable credit, 580,000. On the 24th, I paid $410,000 to my suppliers. So here my journal entry is going to be, I'm making a payment, so cash credit, accounts payable debit, because I now no longer owe that money. Accounts payable debit, cash credit, $410,000. On the 27th, the receivables that I have in my books, I decided to write off $2,500 of those receivables. I am writing off a receivable, which means I'm taking it off my books. I'm crediting accounts receivable, $2,500. The question is, what account do I need to debit? As I'm using the allowance method, I have to debit the allowance for uncollectible accounts. How do I know I'm using the allowance method? If you look up at the list of your accounts, you have allowance for uncollectible accounts. You know you're using the allowance method based on that information you have there. And again, also that is what is accepted, generally accepted accounting principle tells us we should use the allowance method and not the direct write-off method. And then finally, the last piece of information tells me that I had a transaction in which I paid my employees $128,000 and I'm paying them for salaries. So this is a fairly easy journal entry where we have salaries expense debit, cash credit, $128,000. So at this point of time, I have all my transactions recorded in my journal. There are two book entries. This one where I'm doing the perpetual, in the perpetual method, as soon as I make the sale, I do cost of goods sold expense debit, inventory credit, and this allowance for uncollectible accounts, accounts receivable credit. This one is also a book entry. These are not transactions, these two entries. So I'll just highlight them over here for a second so that we know that these are book entries. These are not transactions. Transaction, you're always dealing with an outside party. All the others are transactions that we've looked at over here. Two of them were book entries. Okay. Now let's move on to the adjusting entries. These are all book entries. Adjusting entries are all in my books. So let's start with the first one. At the end of January, the company estimates that the remaining units that we had purchased on Jan 12, that's 100 units that we had purchased on Jan 12, we expect to sell it in Feb only for $100 a piece. So the new information we have over here is saying that on Jan 31st, I think these 100 units, the best I can sell them for is 100, which means I'll get only 10,000. So I purchased it for 11,500. On this day, when I'm going to prepare my financial statements, I know that I cannot sell it for 11,000. Actually, I hope to always sell it for more than what I bought it for, but in this case, it's even less. So this 1,500 drop in value is an unrealized holding loss. The reason we use the word unrealized is it's not yet happened. However, in the perpetual inventory system, what we do is on January 31st, we pretty much say, you know, I'm not going to get that 1,500. I need to write down my inventory. Okay, I'm bringing the value down by crediting it. And in this case, I just put it to cost of goods sold. I add it to the cost of goods sold as if it was sold. I know it's not sold. The value has just gone down, but I pass it to basically cost of goods sold as an expense. It hits my net income number, which is what I'm doing. I'm devaluing my inventory. I'm bringing down the value of my inventory by 1,500 over here. That's the reason it's important to keep these records over here. The second piece of information tells me that the company records is going to record an adjusting entry of $3,000 for estimated future uncollectibles. So again, this is a fairly straightforward journal entry, and they've given me the dollar amount, bad debt expense debit, allowance for uncollectible account credit, and that's $3,000. I was given that number, $3,000. The third piece of information tells me the company accrues interest on the notes payable for January, for the month of January. Interest is expected to be paid December 31st, end of the year. Okay, so let's go back up over here. My notes payable, 8% due in 3 years, $30,000. That money is not due right now, but that interest is accruing, which means I have to pay that interest eventually. So let's first see what accounts I debit and credit. Interest expense debit, interest payable credit. I'm not paying it on January 31st. I'll pay it on December 31st. Now the next question is, how do I calculate this interest? Interest is always calculated as the principal amount, which is this $30,000, the $30,000 over here, the notes payable, multiplied by the rate, which is 8% per annum, multiplied by the period. We are doing accrual only for 1 month. So it's going to be 30,000 times 8% times 1/12 for 1 month. Always be careful and see what period you're doing this adjusting entry for. So 30,000 times 8% times 1/12 gives me $200. So that's my accrual entry. Let's continue. And the last piece of information we are given is the company accrues income taxes at the end of January of $12,300. Again, it's an accrual entry. We are saying we owe on the profits we've made $12,300. Income tax expense debit, income tax payable credit, $12,300. Okay. Let me again expand what I have over here. We can see this. Again, just going back to some of these arrows that I had put in over here in place. Okay, after we've done all our journal entries and adjusting entries, I will post everything into the T accounts. Remember, I first start out with the beginning balances, post all the journal entries, and then the adjusting entries and find the balance in the accounts. I have done that over here. Let me go ahead and highlight everything and you can see this information now. Once you see this information, you will see that all my accounts are done over here. I've completed posting and closing all of them. Now this information goes into my adjusted trial balance. It's called an adjusted trial balance because all these T accounts include all the adjustments that were made. Remember, in a trial balance, whichever trial balance it is, this is an adjusted trial balance, you will list the accounts that only if they have a non-zero balance. In this case, they all have a non-zero balance. So I list all of them, and assuming I've done everything correctly, my numbers that I get over here at the end, the totals. So let me call this totals. The totals have to be exactly the same, obviously. They cannot be different. Total debits must equal to total credits over here. Okay, total debits must equal to total credits. Now, what's the purpose of this adjusted trial balance? In addition to finding out that total debits equal total credits, we use the adjusted trial balance to prepare the financial statements. So I'm skipping that step over here. After your financial statements have been prepared, you need to get ready for the next accounting period. In this case, it's next month, but I need to do closing entries to close out all the temporary accounts. So what type of accounts do we have? Assets, liabilities, owner's equity, revenues, expenses, and dividends. Assets, liabilities, and owner's equity are permanent accounts. You do not close them. The ones that you close are your revenues, expenses, and dividends. In this exercise we've gone through, we don't have dividends, so don't worry about it. So let's find our revenues and expenses. I'll highlight them over here. This is my revenue. My revenue is sales. My expenses, cost of goods sold is an expense. We don't write the word cost of goods sold expense, but it's an expense. So make sure you close that one. So I'm going to close all of these. And then income tax expense. Interest payable, income tax payable, these are liabilities. These are permanent accounts, they're balance sheet accounts, they're going to stay. You don't close those. Okay, so your revenues, expenses, and dividends. So how do we close them? Again, they're done on January 31st. Sales has a credit balance, that's a normal balance. To close it, I need to debit the sales account $600,000. I'm going to transfer that amount into retained earnings because remember, revenues are really an owner's equity account. So I credit retained earnings and I debit sales. So sales now has a zero balance. After I post this journal entry, sales is going to be at zero. All my expenses have debit balances. Therefore, I need to credit all those accounts to bring them down to zero. I will debit retained earnings, add up all of these numbers, and that's what will go in over here. Debit retained earnings, 582. Now, you should have prepared your income statement. The income statement, you will have revenues minus expenses. In this case, 600 minus 582. Your net income should be 18,000. So this is another way in which you can check. Okay, so at this point of time, we are done with the accounting cycle. We skip the step of preparing those financial statements. It is required for the exercise, but that is a separate video that I will put out. Okay, so this is our homework assignment, and hopefully this is going to be very easy now that you have gone through it with me over here.